Hey everyone, stock splits are increasing in popularity again as the stock market rally in 2024 has boosted stock prices. Some of the more notable stock splits in recent weeks have been Nvidia, Chipotle, and Broadcom. Nvidia is already trading on a split-adjusted basis, but Broadcom and Chipotle have yet to split and trade on a split-adjusted basis. They've made their announcements for the decision to do so. In this video, I'll compare Chipotle and Broadcom and answer which one I think is the better stock split stock to buy today. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10. All right, so on a pre-split basis, Broadcom and Chipotle shares are trading at $1,659 and $3,213 per share, respectively. These are very high prices, and for those of you that don't have access to fractional share buying, it might be out of reach. So the stock splits will make these shares more affordable and more investors can have access to these two stocks. But I've often said that a stock split does not change a company's prospects. Revenue, profitability, cash flow will not be impacted by the stock split. The share price will be a fraction of where it was before, and so more investors will have access to buy. But the fundamental aspects of the business will remain unchanged. And that's an important thing to remember, as a stock split generates a lot of enthusiasm from investors, brings a lot of investors into the market, and some investors might not realize that the company's prospects are not changing. There is no improvement happening, even though there's a lot of enthusiasm around. It's just a splitting of the shares, a slicing of the shares into smaller pieces. That's all that's happening. That's important to remember, and I wanted to highlight that here again in this video. So looking at some of the fundamental aspects of these two businesses, you'll notice revenue growth has been excellent for both. Broadcom increasing all the way up to $42.6 billion in revenue. That's up from a fraction of that amount, closer to $6 or $5 billion in revenue in 2015. Of course, Broadcom has done an excellent job digesting acquisitions. It's been an acquisitive company over the last decade, and it's demonstrated skill in making acquisitions. Not very many companies have been able to do that. In fact, most companies making acquisitions spend wasteful sums of money overpaying for their acquisitions and then having to make a huge write-down later on as they admit to investors that they paid too much. But not Broadcom. Broadcom has demonstrated skill, and its most recent acquisition of VMware is already going better than expected. The company expects that acquisition to pay dividends very quickly, as it's found ways to cut costs and increase revenue from that acquisition. So already, again, Broadcom demonstrating skill in that regard. Chipotle, meanwhile, has done a great job serving its customers. It's been one of the better restaurant companies in the US, growing the number of locations and growing the amount of revenue per location. Chipotle was one of the first to embrace the food delivery side of the business, and in combination with its brick and mortar side of the business, it's grown very nicely. As a result of rising inflation, Chipotle has implemented several price increases on its menu, and given that its customer base trends toward higher income individuals, they've been able to absorb those price increases and return to Chipotle and not decrease their spending with Chipotle. So lots of room for growth for both Chipotle and Broadcom, and they've both demonstrated skill in their respective fields. Now, when we compare these two on operating profit margin, we can see how Broadcom has really separated itself from Chipotle starting in 2017, when their operating profit margins were similar. But now you can see Broadcom's operating profit margin is more than double that of Chipotle. And given that Broadcom said the recent acquisition of VMware is likely to add to its total operating income, and the operating profit margins from VMware are likely to reach those of Broadcom's business, the rest of Broadcom's business, which is very profitable. its profit margin is likely to bounce back higher over the next few quarters as it digests this acquisition and makes those cost-cutting and revenue-enhancing changes. Chipotle, meanwhile, has done a great job too. Its operating profit margin rising to 16.71%. As I mentioned earlier, the menu price increases are offsetting rising costs for Chipotle, and more recently, it implemented another round of price increases to offset minimum wage increases in California, which is one of its largest markets. So 16.71%, and management has highlighted that it can approach over 20% in operating profit margin in the long term. So profit margin expansion for both Broadcom and Chipotle in the cards for the next few years. The next metric to compare is cash flow from operations to sales. And again, Broadcom demonstrates an advantage here with the cash flow from operations to sales at 44%. Chipotle, meanwhile, at 18.6%. I will highlight that up until this point, Chipotle has been an owned location business. What do I mean by that? Chipotle owns all of its restaurants. It's not a franchisee type business. If it chooses to go the franchisee route at some point in the future, that would enhance the cash flow from operations to sales ratio and the operating profit margin ratios, but it could come at the expense of some other downsides. So for now, Chipotle choosing to go the owned location route, and that business model choice gives it better total revenue opportunities because it's not only going to be getting a fraction of the revenue through royalties, but it also weighs down growth and it weighs down profit margin as it's a slower growth path and a riskier path longer term. All right, finally, I wanted to compare these two on valuation. And surprisingly, Chipotle stock is trading at a much more higher valuation than Broadcom. Chipotle is trading at a forward PE of 48, compared with Broadcom, which is trading at a forward PE of 27.68. So if I was to choose between these two stock split stocks to buy today, I would choose Broadcom stock because of the better performance and because of the cheaper valuation. Now, I will note Chipotle's premium valuation is because it's been a best-in-category business. I liken Chipotle to that of Costco. Costco has always traded as one of the more expensive brick-and-mortar retailer companies because it's the best in class. And similar with Chipotle, it's traded at this premium valuation in the restaurant category because it's the best in class. So that's why you see this premium valuation for Chipotle. Still, for my preferences, I would prefer Broadcom over Chipotle, acknowledging the fact that Chipotle is the best in class in its category. However, I don't want to pay that premium valuation for a restaurant business. So I would pick Broadcom over Chipotle. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.